Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. No time to goof around today, people, because we got John Butters in the bullpen, and he's coming in hot. Market call, 1 o'clock on the East Coast on this January the 15th. Rangers, tough loss last night, up 2-1 late. Colorado pulls a goalie. They score, then they win it in overtime. Good hockey game. Dan, Nathan, and I were at the St. John's Georgetown clash last night at MSG. St. John's in the second half dominated, deservedly so, and won the game. What else is on my radar screen?
I give the Hoyas like A for effort there, because
you know something. You don't get effort points.
They were playing on a big stage. It's the second year of a new coach. I think they came into the game 12-3. So they're doing things, and I'm optimistic into the Big East. Into the Big East matches here.
Duly noted. But that was fun. But here we are on this 15th of Jan, and as I mentioned, we got John Butters waiting. So without further ado, let's get into it, Dan.
Well, it's interesting, Guy. Last night on Fast Money, we had this discussion in front of the CPI. We're gonna obviously dig into that a little bit. We talked a bit about the rate move, and again, rate move today is big. We're gonna hit that for a second here. The dollar move initially, we're down with rates, but you see the U.S. dollar index. We're gonna hit that also. Has rallied back a little bit. And I think the debate that we were having on the desk of Fast Money again was, what's more important, the macro and some of the economic data, or earnings season? That's what we're going to hit with Butters here. What are expectations, and what do we think coming out of that we're going to see for Q1 guidance in 2025? But let's hit, Guy, the CPI. Again, it's the third consecutive month where actually it has risen, but it rose less than expectations here. So give me the 411 on what you were thinking. I don't think you thought it was going to be a super hot number, but you thought the continuation of a trend over the last few months, at least it has stopped going down. That's the most important thing.
Yeah, it feels to me as if you have something for everybody, right? Obviously, the market's breathing a collective sigh of relief. That came after the PPI number, CPI today, so people are going to say it's trending in the right direction. I'm not one of those people, by the way, and I'll say this as well. I think this rally in TLT or move lower in yields is going to be somewhat short-lived, and we'll see what happens with the next meaningful auction. With all that said, yeah, I think people are sort of saying, maybe they're sort of skating their way through this thing, they being the Federal Reserve, and perhaps some of the more dire prognostications in terms of no more rate cuts this year. I mean, maybe those concerns have been somewhat assuaged. We'll see. But, you say what you want. I mean, here we are 3 years later or so, or 2 years later, and inflation is still a problem for people. So there are a lot of people, and I don't want to get, this is not political, but a lot of people watching and saying, hearing people espouse and wax poetically about how great this inflation data is. For a lot of people, all it means is they're just hurting a tad less, but it's not like they're on the other side of the fence yet.
Yeah, so if we look at the CME Fed Watch tool here, obviously, the end of the month, we're going to have a meeting, and it's still like a near certainty that the Fed is going to hold serve here a little bit. Then we want to take it out. I'm looking at March, Guy. It's a 74% chance that, again, that we are, not going to see the Fed lower interest rates. And then you go out to May, and it's becoming, a bit more evenly focused, 58% or so chance that we're still at 4.5% on the upper bound of the Fed funds rate. And, when I look at the S&P, we're looking at the futures chart here, the E-minis, Guy, you see this downtrend that we've been in. We talked about it yesterday, a series of lower highs, a series of lower lows. You get a gap move. Maybe Jacob could pull up an intraday. We've been kind of skeptical of gaps over the last kind of month or so, because it looks like the mood in the markets, at least the stock market, has changed a little bit. The mood in the treasury market has changed as far as yields. And let's see if today is a one-day phenomenon. You get a gap higher in stocks, you get a gap lower in yields, and that's why it really comes down to earnings. Does that make sense to you?
No, it's fair. I think your point is well taken. And, I think a lot of people now have been with us for a while. The first thing their eyes will catch is this sort of downtrend that the S&P has been in since, I don't know, early December or thereabouts, right? And you can, this is a static chart, but if Jacob were to put up a a different chart, you can see, and you can draw that downtrend line from those highs we've seen. And I think what we've done today is effectively reach back up to it. Now, I think for me, it would have been great if we traded down and sort of kissed that 150-day moving average, which we didn't do. But you know what, Dan? We didn't do it in September either, and the market was just fine with that. So here we are. I mean, I think the downtrend is still in place. I do think the 150-day gets tested at some point again. I do think, again, to use that term, there is a collective sigh of relief today, and bank earnings obviously helped a little bit as well. But, you know, here we are in the earnings season now, and the VIX is back down to 16.5, 17. So a lot to like, a lot to still be concerned about.
Yeah, so let's look at the Nasdaq 100, the futures here, the E-minis, and you know this looks basically the same thing, right? And so sometimes I like to take a look at some of the big names in that index and just kind of see how they're influencing the move of the day. We see that you know the VIX has come in, guys, so you know that's obviously tagged to the S&P 500, but you know the Nasdaq VIX has kind of been a bit more elevated, obviously because we have the fateful 8, those top 8 stocks in the index that make up nearly what 40% of the Nasdaq 100. And so on a day where the Nasdaq 100 futures are up nearly 2%, I see Apple underperforming that. I see Microsoft basically in line. I see Avago, that would be the Broadcom, underperforming that. But then you have names like Tesla. You know, it's just, I guess the Tesla, and maybe you can help me with this one. If higher interest rates were going to be more difficult for Tesla, right, to either sell or lease cars, you know, lower expectations of interest rates is good, but not much lower, guy. And then when you look at this 5.5% move on this chart, it basically looks like a blip.
You know, these are Pavlovian responses, though, and I know you know this. I mean, if we could do a longer-term Tesla chart, the fact that we got down to 380 or so, I mean, that actually, and we talked about it on Fast Money, you know, if you draw sort of a line across from those levels we've seen before, I mean, this had been sort of resistance. So, again, that prior, you know, I'm sort of fudging it a little bit, but you can see what I'm looking at. That prior resistance becomes support, and I think to a certain extent we found it here in Tesla. But I think the point you make about lower interest rates, yeah, I think that's probably contributing this as well. It's interesting. Gary Webb has a question, and Gary, I'm going to put it up, but I don't know. I don't understand the question. His question is, what do you believe is the greatest contributor to liquidity today? I don't, Gary, maybe help me a little bit and send another question, because I don't necessarily understand. If you're asking, why do you think the market's higher? I think that's what Dan and I have been trying to address for the first few minutes of the show. But in terms of liquidity or, you know, money flows, you know, I can't speak to the driver of it. I can speak to one of the reasons why I think is going on, as we've sort of outlined.
Yeah. Yeah, interesting question. I mean, again, I think a lot of it has to do with, to Guy's point, the passive investing, right? So we've had this little bit of a downtrend over the last month or so, and all of a sudden you get a reason. And, you know, sometimes it's the algos, right? You get a 10 basis point move lower in the 10-year yield. And that, what does that equate to? Does it equate to 1.5% in the S&P 500 because the machines start buying? So I get it. I think the smart money, and I know we hate that, you know, and when I use that, I think it's relative to, let's say, the algos. I don't mean there's any dumb money out there, but the algos, which are kind of picking up off of like headlines and economic data, I'd say the smart money are the people, and they're not always smart. They don't always outperform the market. A lot of these hedge funds that charge 2 and 20, they're underperforming in up markets, but we can go into that on another podcast here. But when I think about it, those are the ones who are actually placing their bets based on a lot of qualitative data, and obviously they're working a lot of quantitative data. So maybe that's where this increased liquidity comes from. Also, in a day where you see the banks raging after some of the earnings, we're going to hit that in a second. Guy, we got to talk about your gold.
Yeah, let's do it.
We
got a little trade here.
We have a dollar move. I know that you've been all right. So there's the yield. It had that huge move. All right. So this chart, Guy, and I forgot to do this. If we drew a downtrend line, right, from the October high, and you look at that November high, and now you
formation.
There you go. I'm just going to let you go with it because, you know, this is your bag.
Well, I don't know if it's my bag. By the way, you know, it's funny you say that because you were on the set, I think it was last night, where Tim Seymour and I were waxing poetic yet again about Bag from Happy Days. He was he was only on 4 episodes. He was one of, I think he was the leader of the Demons. But as you mentioned, this is my bag. And, you know, if Jacob wants to do a non-static chart, he can draw that downtrend line that you just talked about. But let's look at this quickly in terms of the trading gold. What I've said for a while, and I'll stand by this as well, you know, gold was going higher as the dollar went higher. Gold was going higher as yields went higher. Gold was going higher, generally speaking, under circumstances where historically it would not do well. Now, today's move makes sense. And, you know, I was with a couple of guys last night at the aforementioned Georgetown St. John's game, and we had a pretty detailed conversation about it, because these are all men, by the way, that spent their lives trading this specific commodity and others as well. And they're also of the belief that, you know, it's just going to be, you know, what's sort of going to be the match that ignites this. So maybe it's with yields going lower. Maybe that's the start of it. Although, as I said earlier, I don't think that's going to continue. But this pennant formation, which you sort of highlighted, I think it's going to break out to the upside. And I will continue to stand by that. I think gold will continue to be a story.
Yeah, so let's just look at your levels here. So you're basically saying, yeah, we're up 30 handles here on the gold futures, and I get it. So the idea of chasing it here a little bit, maybe you kind of wait and see how it holds in and around this 2,700 level. I'm sure, Guy, that's what you're thinking here. And you want to stop that, I guess, really close. That's the yesterday's low in a way. You know, you break that, maybe you get back towards that uptrend. So you want to keep your stops, in my opinion, really tight. And, you know, you mentioned this point. I think it's really interesting. Gold was going up when the dollar was going down. That's the relationship that a lot of folks have gotten used to. But gold was also going up when the dollar was going up. And in this last move, it's really been consolidating, let's call it, between, I don't know, you know, 20, what are we looking at? Like 2,400, 2,600, that sort of thing.
2,600-ish, but
yeah. Yeah. And so again, tight stop. Your target is that prior all-time high. And I have a feeling that you love breakouts, right? And look at the breakout that we saw, if you want to go back to the summer, right? After that long consolidation. So talk to me a little bit how you trade this if it gets up towards that $2,800 level, because I suspect you are raising the stop the whole way.
There you go. So Jacob just created that pennant. Thank you, Jacob. So there you go. I think that's clear as day. So theoretically, Dan, and you know this as well, but new audience members might not have heard me say this. What winds up typically happening is, as the pennant continues to sort of narrow, the ranges of whatever you're trading, whether it's an equity, a commodity, a currency, typically narrows as well. And then you have some reconciliation one way or the other. I will say again, I think that will take place on the upside. So I do think you're going to break out of this pennant to the upside. But to answer your original question, if we were to get up to 2,800, you do raise your stop. So you do the trailing stop that we've outlined a number of different times, and we can talk more about it on other shows. I'll say this as well. If you really want to play at sort of the $100 table, I actually think you add more on strength. So you buy that potential breakout through that prior high in the fall. And I think that's the aggressive way to trade it. And quite frankly, that's how I think that's the way it's going to play out.
Yeah, no doubt. And so let's just pull up that Dixie chart, the DXY, the US dollar index. I mean, look at the move that this thing has made. I think you and I, Guy, you know, it's rare to see a 10% move in such a short period of time in a currency like the US dollar. You've talked about the bond volatility that we've seen. That's something that's been kind of unusual. So in macro land, I think things have been a little funky where, you know, the S&P has just been a slow grind. The NASDAQ has been a slow grind. So this year, given the volatility we're seeing and some of these other major inputs to, you know, U.S. corporate earnings, I think it might be a bit different than these 25+% years that we've had in the S&P 500. Guy, before we get to the chart of the day, before we get to the call of the day, I just talked about the dollar. We just talked about yields. These are major inputs to U.S. corporate earnings, right? Especially those multinationals with exposure, a lot of exposure outside the U.S. I can't think of a better time to bring in our main man, John Butter. The senior earnings.
Can you see, like, ear to ear, baby, grinning ear to ear? Hello, John Butters.
There he is. Okay. John Butters is the senior earnings insight analyst over there at FactSet. We get a preview of his note, what, every Wednesday? I think every Wednesday. It drops in your email box every Friday morning. So you can get it at factset.com/insight/subscribe. I'm going to give it over to Guy here, John, because he's one really excited person to have you live IRL on the program.
I do get geeked up for John Butters. And again, you know, I kid around, and only kid around because I have the utmost respect for you. And I hope people understand that, because your work is extraordinary. And the fact that we're able to sort of, on almost pretty much on a weekly basis look at it, and we're privy to it prior to some other folks. I mean, it helps us a great deal. And it's something that prior to doing these shows, I know Dan will say this. Yeah. I'll say it as well. It's something that I looked at as well. But let's get into it now, because we're talking about analyst expectations, fourth quarter estimates being lowered. So let's get into it, because I think this first chart that you brought is really interesting. And that speaks to this sort of upper left, lower right of tempered expectations, I guess one could say.
Yeah. So, as we know, coming into the earnings season, or coming into the start of the quarter, analysts were looking for growth about 14.5%. Now, in terms of corporate guidance from companies, we did see slightly more companies give negative guidance. About 71 companies gave negative guidance for the quarter. That's above the 5-year and 10-year average. However, that number was consistent with what we've seen in recent quarters, and it didn't really translate to larger cuts to estimates than average. So I know when you look at that chart, it looks like a pretty significant decline. But believe it or not, analysts usually take their numbers down about 3% during the quarter. And as a result, that's the decline we saw in the growth rate. We started at 14.5%. We're now down to 11.5% today. And it's important to note, even at 11.5%, that would still be the highest earnings growth for the index going back 3 years. And we know that every earnings season, companies beat the estimates. We usually see that growth rate go up. So it wouldn't be surprising at the end of the day, when all said and done, we finish right around that 14 to 15% growth rate that analysts were looking for back on September 30th.
Yeah, which lines up, John, because we've been reading your work for 2025. Estimates are what, 13, 14% for the full year. And I guess the point is, if this kind of trend continues, you're going to see each quarter some of these estimates come down. You lower the bar, these companies beat them, right? They give, guidance in line, and then the, estimates come down by the analysts, then they beat those. I think what's interesting about this chart, and Guy just mentioned, upper left, lower right, the opposite is true for the US dollar. That's what we just kind of targeted a little bit. The opposite is true for yields. And so if we're going into a more volatile macro period, especially when we have a new administration here in the US, we have a weakening Europe, right? We have China, which is an absolute disaster. You think of multinationals and you say to yourself, this is about as tricky of time as we are, heading into 2022. And we know we had a bear market. But let's drill down a little bit, John, on some of the sectors that you're focused on here, because obviously some are much bigger contributors than others to S&P 500 earnings.
Yeah, so overall, if you look at the sectors, 7 sectors expecting growth, but 6 expecting double-digit growth. So fairly broad-based growth expected this quarter. It's being led by the financial sector with growth at 40%. And we saw the banks today, a number of the large banks, JP Morgan Chase, Citi, Wells Fargo, all beat estimates and had pretty solid earnings. And the banks are the industry leading the way in terms of that 40% growth. But even outside of that, 3 of the other 4 industries are looking for double-digit growth in financials. So fairly broad-based growth there. The sector expecting the second highest growth, communication services, at a 21%. This is a story we've talked about the last couple of quarters. Again, Alphabet, Meta Platforms, and also Netflix are all driving the growth there for that sector. And then third, we've got information technology at 14%. Again, the semiconductor industry led by NVIDIA is driving growth there. If we look at the flip side, energy expecting the biggest decline, earnings expect to be down 30%. Obviously, oil prices contributing to that. On an average basis for the quarter, oil prices were down 10% year over year, Q4 24 versus Q4 23. The integrated oil and gas companies and the refining and marketing companies both driving the earnings down in the energy sector. Materials next, decline of 5%, fairly broad-based weakness there, led by containers and packaging and metals and mining. And finally, the industrial sector expect to be down 4%. Guy, I know this is a sector that you focus on. Really 3 industries driving the weakness there. You've got aerospace and defense, a lot of that weakness coming from Boeing, the machinery industry, and also the industrial conglomerates. One bright spot in the industrials, the airlines, passenger airlines, looking for growth of over 40%, but net looking for a 4% decline in that sector.
Yeah, Dan, it's interesting. I look at this and, obviously my focus is immediately to the far right. And I look at those 3, industrials, materials, and energy, and I say, okay, if I look at this very quickly, my instincts suggest that speaks to an economy that's slowing down. And that's probably some truth to that, number one. But number 2, as John just said, I mean, each one of these sort of has its own, idiosyncrasies around it. Industrials is Boeing and aerospace defense names. I mean, real quick, if Jacob can put up like a Lockheed Martin chart, for example, and see the significant drop that stock has seen since the election, you can start to see some of the idiosyncratic things around it. So that's industrials. Materials, well, as John mentioned, metals and mining stocks. I mean, the gold mining and silver mining stocks have just not performed. And you throw sort of, you want to throw copper in the mix, Freeport McMoran, for example, that's sort of been mired in nowhere's land. And obviously energy, it's its own animal. So as much as I would like to point to this and say, wait a second, Dan, this is a cautionary tale, I think it is, but not nearly to the extent that I think first glance would suggest.
Yeah, and it's not just our economy that you could kind of extrapolate this to, but there's a lot going on. Europe, it seems like Germany is weakening. We obviously just mentioned China. It's no good over there. Obviously what's going on in the Middle East, very much related to that kind of oil trade there. So again, a lot of uncertainty. But John, let's talk a bit again about 2025. We just kind of hit it before. And so you have a slide here, pretty interesting stuff. Analysts still predict improving earnings growth for S&P 500 outside of the Mag 7. By the way, and you could start using this, okay? We're calling it the fateful 8. When Broadcom,
whoa,
you know that guy.
What was you said we are?
Oh, well, I mean, I think I'm going to get you sooner or later.
No,
you're not going to say it, but you can acknowledge it.
No, I'm acknowledging it. Yeah. No, yeah.
About a month ago, John, as you know, Broadcom had a huge 2-day 40% move. Okay. And it just joined that $1 trillion club. So that's why we threw it in there with a Mag 7. That's out. We got the fateful 8. The fate of the market is in the hands of those 8 stocks. But your slide right here is saying something different here, because the idea of broadening out of earnings growth away from these 8 stocks is going to be a really important story in 2025.
Exactly. And I think it's a theme we've talked about the last couple of times I've been on. So if you go back, say the last 6 quarters or so, really any earnings growth we have been driven by, these Magnificent 7 companies. And this quarter really reflects an inflection point where there's much higher growth expected for the companies outside of the Magnificent 7. We have here, it's 8.5% growth. That's the highest growth for those 493 companies, if we hit that, going back about 2 years. And again, we talked about some of the drivers. That financials will be a big driver of that this quarter. In the healthcare sector, pharmaceuticals are also expected to be a big driver of that. And again, what's interesting here is this isn't just a one-quarter aberration. The analysts are expecting this improvement as we go through all of 2025. And what's interesting is it's not really one sector leading the way. So for example, in Q4, like I mentioned, financials and healthcare are helping to help that 8.5% growth. As we get into the first half of 2025, it's healthcare and industrials. And in the second half of 2025, analysts are expecting a rebound in energy and materials. So from different areas are all contributing to that growth. So again, as we talk about each quarter, you're going to want to watch the guidance, because it's not like the Magnificent 7 are going to do terrible. You're looking at 20% growth for most of these quarters going forward. But it's really these other companies that are expected to drive the overall growth rate up. And again, we'll have to watch with, Dan, all the factors you talked about, these macroeconomic factors, if these growth rates are going to hold up going forward.
Well, I mean, this is fascinating because, if you just look at where fourth quarter 2024 is, I mean, you can see the discrepancy between the two. And by same time this year, you're going to narrow that gap down to 4 percentage points in terms of the skew. So the optimist is going to say, there's your broadening out, Dan. Here it's happening right before our eyes. And, if the market can just continue to hold serve, and if these things sort of level out, I mean, I think that's to a certain extent best case scenario.
Yeah. And so John just mentioned the macro thing. So the dollar, the rates, again, but we have uncertainty about tax policy. We have uncertainty about deregulation. We have uncertainty about tariffs. So again, I think the key here is uncertainty, and which is one of the reasons why we love your work, John. We've been tracking it for years, and just kind of, it's a great guidepost for me, when things get a little quiet mid-sector or mid-quarter, but really most importantly right now, as you kind of look at the previews into earnings season and then you track it throughout. So John, we really appreciate you being here. If you want a copy of John's earnings insight, you can have it in your email box, factset.com/insight/subscribe. It's free. Go get it, people. John, thanks so much for being here with Guy and me on the Market Call.
Great. Thanks for having me as always. Appreciate it. We'll talk soon.
I love Butters. I mean, am I allowed to say that?
Of course. You love him. He's the man.
So we're through the clippable part, so I'll just say it. I mean, he's just a badass.
Yeah.
And I'm just telling you.
Yeah.
Massachusetts guy, Butter, you know what? You don't want to tangle with Butters. I'm just telling you right now.
All right. So
is that fair?
It's 100% fair. I mean,
Yeah.
it's 100% fair. No, his work is great. And long before we had this relationship with FactSet, which is going on our 5th year, and they've been a great, great partner of ours. I've been reading Butter's work. I know you have too. And actually, before we ever, did any work with him, I used to quote it on the CNBC's Fast Money. You know why? Because he's a lot smarter than me, and he comes with receipts. That's what the kids say, Guy. I want to hit a couple things.
Whoa. What?
If you bring receipts, that means you got the goods. You know what I mean? You know what you're talking about.
The people, no, listen, first of all, okay, I understand what a receipt is. I'm actually still one of these people that likes to get receipts.
Yeah.
Nowadays, if you go to a restaurant, like they don't even bring you the check anymore. They bring you like this box, like
no,
this,
they bring you a little thing, like a toast,
and then they ask you. I'm like, what am I doing here? What is going on? Like, why?
That's what you do, but most of us.
There was a time when, if you recall, they would bring you like this leather bound thing, and you'd open it up, and there'd be a check in it, and you'd look. I mean, I'm not one
places
of these,
that you
then
go.
You put your credit card in or cash, and you
that.
hand it back to them, and you don't do that anymore.
The places you go still do that. Yesterday on the market call, I detailed a bearish trade idea in the XLF, the ETF that tracks the banks. We went through the fact, the way that thing is constructed with Berkshire as the largest holding. It's not a perfect pure play on just banks. Jacob just pulled this up here. We were looking at a downtrend, not too different than what we kind of detailed in the broad market. Obviously, you have a huge gap. Okay, we have another week or so of bank earnings. Let's see how it plays out. We paid 35 cents for a $2 wide at the money put spread that expires next week. We often talk about how we risk manage long premium directional trades in the options market. We use a 50% premium stop. Well, you're over there at this point. So that gap makes it really difficult. I think you stick with it for now, Guy. Let's see if that gap gets filled in a little bit. Let's see if a lot of these stocks can continue to go. Your inclination was that off of earnings, bank stocks, at least the money centers, they rally, but you thought there's a good chance that maybe they come in, help my trade.
Well, we've seen it before. So we talked about the potential for JP Morgan to rally, and a lot of the names that we mentioned. Citibank, by the way, is a name we've liked for a while, and I can get into the reasons why. I'm sure we'll talk about it on Fast Money tonight. But what I also think is going to happen is this rally is going to be somewhat short-lived, and I do think, like we've seen many times before with these banks. I mean, typically at the beginning of earnings season is when these things spike, and then they spend the next couple of weeks sort of back and filling. And I do think that's what we're going to see here.
Yeah. So again, we just wanted to full disclosure. That's how we were lining up on this sort of thing. And, it got oversold. Let's be clear. It almost filled out in that entire gap from November 6th. So let's see if they're going to fill in this gap in the not so distant future. Do you want to hit the call of the day?
I do. And you know why I want to hit the call of the day? Because without giving it away, it's Lululemon. And, look, I admire analyst calls without question, but it's funny. We talked about Lululemon yesterday, and we said, so here's the call. Wells Fargo ups their price target. Right now, they're 21 buys, 11 holds, 5 sells. I think the average price target is like $400-ish. I'm rounding up. But you also have a pretty big skew in between. What I said yesterday was, and I'll stand by this as well, the move that we've seen, if you do a little longer term chart, I said, effectively, we've just done a 50% retracement of the prior all-time highs and the lows that we saw in August. And my inclination to use that term again was to probably fade it. And at least today, that's seemingly correct. So maybe these, who knows what this is on the back of. My sense is playing a little stock market here, but this is a level where I think we consolidate and then potentially trade back down to the 150-day moving average, which is 350 or thereabouts.
Yeah, it's pretty fascinating when you get 2 analyst calls like that, and then you have the sort of price action that we have here. I think you and I would both agree, and we took a look at this over the summer. We put on a bullish trade in the options market. We were looking for a move back towards $310. Well, you think we got there. We majorly overshot it, and you see that move on earnings. So I like that little flag there. Let's see how it kind of holds this pattern a little bit. Valuation is probably becoming a little bit challenged, Guy. It was cheap in the summer. It's not so cheap now. which brings us to the chart of the day. And it really comes from a question that we wanted to look at here. This is from a viewer. Maybe Jacob could pull up that question.
From Chris L.
There you go. Why don't you read that for me? Because it's for me, so you have to read it to me. I can't.
Question for Dan.
Yeah.
Do you think shorts are piling into NKE? Question mark. Seems like every single pop gets sold down intraday.
Yeah.
That's a great question, Chris, and it's something we've talked about, and I am in agreement with your thesis. I think that might be going on. There's also a valuation concern, but I'll let Dan opine because theoretically, we should be at levels where this thing holds.
Yeah, which is kind of fascinating. You just brought up, valuation. We can talk about, kind of some of their end markets geographically. We know China is very weak. We know that last year we had the benefit of the Olympics and a few other things. The NFL is getting done. So what are the catalysts here? That's not the only catalyst, some of these big events, but here's a company that really needs to figure out who they are, right? And we've been talking about that for years. So if Jacob wants to go to the 5-year chart, Guy, I agree with you. If that thing bounced there, it would look like an epic double bottom. The only problem is, and this is what Chris L is alluding to, that every rally gets sold, and whether they're long holders looking for the opportunity to get out or shorts kind of piling in, I don't know. And we talked about this, I want to say a week or so ago, Guy, on Market Call. I just don't know how this thing does not complete this kind of 5-year move and get back towards those COVID lows, because there hasn't been a reason for folks to really get in there and get behind this story until there's a bit more of a reckoning.
I think that's fair. I think that that's the ultimate target. You obviously have new management in place. What I've said for a while about Nike is, the challenges they have been long coming, and they're structural. I don't think they're an easy fix. Competition is not an easy fix. Valuation, obviously, is never an easy fix. It requires either you're going to grow out of it or you're going to trade down to levels that make sense. So that's out there as well. And you throw in the mix, obviously, the Chinese factor as well. And I think, that's sort of like a sword of Damocles. So I'm still not a buyer of Nike here. I think there's going to be a level. I don't think we're at it yet.
Yeah, it's probably 60. And if it gets there quickly off of some sort of like weak guidance or weak performance, that's probably where you start dollar cost averaging. And, maybe it's got a 5 handle on it at some point, but no one's going to be able to pick the exact bottom. So great question, Chris L. You got us looking at the story again. We appreciate it. Guy,
good questions, man.
Yeah, look, before we get to a couple questions, I just want to hit this slide that Jacob put together, because this is something that maybe you and Danny Moses can hit tomorrow on the On the Tape podcast.
Sure.
It seems very much in his
drops in your favorite podcast store.
Whatever your favorite, whether it's Apple, whether it's Spotify, whether it's Stitcher.
It really is. I mean, that's real. This is not directed at you. I'm being serious. Not directed at you.
Yeah.
It's one of the dumbest things I've ever heard. I mean, nobody has an effing favorite.
Yeah, they do.
No, they don't.
Yes, they do, because there's about 5 different places, major places, where you can get a podcast. You can get them in Apple, Spotify,
and they're all.
You get them in.
You get like a toaster with some of them. Like,
Guy, you have to pick one application. The last thing you want to do is have a bunch of different podcasts come into a bunch of different apps, and you don't know where they are. So it's kind of like the same thing. Are you an Apple Music guy, or are you a Spotify guy? I know you're a Spotify guy. That is your favorite.
When we did the Sirius radio show, what was the platform that I was supposedly using?
Oh, shit.
Pandora.
Supposedly using
Pandora.
Yeah, but so Guy couldn't quote his Spotify playlist.
Well, Dan, we used to get mad. He's like, "You can't talk about Spotify. That we're on Sirius. They don't use Spotify." I'm like, "I have no idea what you're talking about." I'm like, "I have no idea what you're talking about," but I'll appease you.
It was one of the first streaming music applications. It was well before Spotify. It was like, it's over 10 plus years old. So good on them for getting there early. All right, let's throw up this slide again. You and I are not going to get deep in the weeds on this. And I'm asking you, I will not be on the On the Tape podcast tomorrow. I would love to hear what you and Danny have to say about this. But it caught my eye because David Rosenberg of Rosenberg Research, he was quoting this story in the FT. And you see that there's a money manager who said that private credit is an accident waiting to happen. Now, my quick takeaway, Guy, I'm reading this and I start digging into the story. You and I have been talking about it. Our friends over at iConnections have a lot of their members who are involved in this space. We've been fortunate to talk to them on the Tape podcast. But if you're in the space, you're not talking about the downside risk to this. And so if you look at the Bloomberg article and that FT one, the two on the right, the banks pushing so hard into this, it's not bullish, in my opinion, Guy. We've seen this again and again with financial companies over the last 50 years. When they get geeked up about something that is not particularly transparent, it doesn't usually end well.
Great setup. Danny and I will talk about this. Obviously, this has been around for a very long time, but I think it really came to the forefront in the spring of last year when, I think it was last year. I mean, my years are getting confused, but when Silicon Valley Bank sort of blew up. Was that 2 years ago? Or was that last year? You know what I'm saying?
It was
23. I mean, that's unbelievable. Anyway, so go back to 2023. So when you saw these regional banks started, I think this opened a window for this private credit to really take over. You know, it's the funny thing about the market is things will find a way of being created or accentuated when something falls by the wayside. And I think to a certain extent, that's what we're seeing in private credit. Now, you mentioned accidents will happen. Great Elvis Costello song, by the way. And I think Rosie is right. Of course, this is not, you know, this is something that doesn't happen, and it happens all at once. But I think you got to shine a light on this. And there may be some indicators out there that will sort of potentially predict or sort of tell us that there are problems. But right now, you know, the market's all gung-ho and everybody's piling in.
Yeah, no doubt. So again, we're going to dig into that a little bit so you can check that out. That'll drop Friday in your favorite podcast store. If you don't already follow the On the Tape podcast, please do. It's a great podcast, very different than here. And what really the different value prop, and we came up with this along the way. And believe it or not, we were doing market call type videos starting in 2020. And FactSet got on board all the way back then, prior to doing the On the Tape podcast, because we love this medium. We love the visual nature of it, the charts and, you know, all that sort of stuff. And obviously, if you're just listening to an audio podcast, Guy, you can't really speak to the charts, can you?
Well, it would be difficult because it is a visual medium. So, and it is amazing. You know, maybe Jacob can go through the archives and figure out what show we're on. But, you know, over that course of time, you start to stack them up, as they say. Sort of the same way coaches stack up wins in the league where they play for pay. You know, if you're in it long enough, you're going to have you like what I did there?
Yeah. But
let me see. Go ahead. What are you going to say?
Guy, you can't say that anymore because they pay.
Friggin' Jacob is on episode 630. I mean, the freaking guy is unbelievable.
Yeah. Well, you're unbelievable. You've been here 630 times.
Well, that was a song, right? Wasn't that a song? Like the hip hop people, you're unbelievable. Jacob, help me out here.
Yeah.
You remember that?
Is that in excess? You're unbelievable.
I don't know. By the way, folks that are still here that haven't fled, Amanda's not feeling well, so send some good vibes her way. You don't have to blow up her frickin' inbox, but you know she's sort of saddled with a little bit of a cold flu type of thing. So thoughts for Amanda. Real quick, Dan. Last question before we sort of get out of here. Guy, does your positive opinion on gold apply to silver and silver miners? That's from Edward Morgan. Yeah, and if Jacob can pull up a PAAS chart, Pan American Silver, there's other silver wheaten as well. Those are the two. Look, I do think silver's sort of, again, setting up, and nobody's talking about silver. People did talk about it, but, you know, silver's getting back in play. And if you're looking at this PAAS, you know, we've been either side of the 150-day moving average. You know, it looks like, as Carter would say, a bit of a pair of twos. But even my eye can look at this downtrend we've been in since October. And if we were to close above probably 23-ish, I think you get a breakout to the upside and maybe test the levels we saw in the fall, Dan.
All right. Before we get out of here.
I just said that before we get out of here. So, okay.
Well, I mean, there could be many things that we hit before we get out of here, because the point in which we get out of here is a single point in time. Everything we do before that.
Right. We're not out of here yet.
Yeah. So you're pretty hard on yourself. I've been saying this to you. I've known you now.
No, let me tell you something. You got to be, man. You got to keep yourself in check.
All right, but that's fine. You're one of those guys that you don't do victory laps, not your thing. Even when you played sports, I'm sure you were head down when you kind of
Head down, baby. Hand the ball to the
No,
official. Act like you effing been there before.
I get it, but
I mean, guys these days, I'm sorry. I apologize.
All right.
Guys these days, I mean, the Vikings were getting their friggin' asses kicked. I mean, they were getting the shit beat out of them the other day.
Yeah.
And some guy makes a tackle for a loss, and he starts doing this shit. Like, are you effing kidding me? You're getting your doors effing blown off in a playoff game in a season where you won 14 frickin' games. You just got your asses kicked by Detroit the week before. You came in here with the Rams, had every opportunity to win. You did not show up, and you're flexing in the effing fourth quarter? Seriously?
So, Guy, one day
is Bill Hockman there? I mean, he's probably doing this.
When Guy's done,
by the way,
when Guy's done with the stock market, which is probably never, to be clear, he would love to be the GM of a professional sports team. It starts as hockey, baseball, football, isn't that the? And if you were that GM of the Vikings, you would have had to sit down.
Let me tell you something.
I know
they got some issues on that team. And what's Oh, see, I'm
well,
sorry, Amanda.
Before we get out of here, I wanted to.
No, but I was going to sort of opine on that game, that Viking game.
You just opined on it.
Had huge ramifications for the New York Giants. And you say, what the F are you talking about? If Sam Darnold played well and they moved on, and let's say they made it all the way to potentially the Super Bowl, chances are that the Vikings would have stuck by him, and maybe J.J. McCarthy, who they drafted last year with their first-round pick, would have been sort of thrown out a potential trade bait. Now that Sam basically, and I hate this expression, but I'll use it, shit the bed the last 2 weeks, his stock is way down. So I think the likelihood of J.J. McCarthy being dealt is much lower now, which means the Giants might have to look elsewhere for a quarterback. See how I connect the dots there, Dan?
Yeah.
No, that's a lot of dot connecting.
It was my bad because I was trying to give you a compliment. And
no, but I don't take compliments.
Well, I wanted to say one thing. If Jacob can pull up Citibank for a second here. So you've been slightly skeptical of some banks on valuation, but this is one that you have repeatedly said over the last year is cheap on a relative basis. They're getting some stuff together here, management, and some of the areas that they've cut, some of the areas that they've moved on to. Let's pull this out as a 5-day chart on that result this morning. Stock's up 7.5%. That's a huge move for a bank. Okay. So you see that gap there. Let's go to a 5-year for a second. So my question is, you got this right. You were never going to give yourself any credit. You're not one of those guys to send out a tweet and just saying, as I've been saying. That's not you. That's other people. So here we are, Guy. We're back towards those early 2022 levels here. What are you doing? Are you pulling the ripcord on this thing?
All right. So first of all, thank you. I appreciate that. So this is a text I sent earlier today to one of the guys I was with at this game last night, and I'll share it with you. My 2 cents on banks. Citi's tangible book is $89.34 as reported today. JP Morgan's tangible book is $97.30. When I wrote this text, by the way, this morning, at current stock prices, JP Morgan is 254% of tangible book. Citibank is 85.4% of tangible book. And I said, JP Morgan is the best in class, but they ain't that good. And currently at that price, tangible book is trading at pre-financial crisis levels. That said, given everything I just mentioned, I think Citi has room up to $90 or so. And, you know, I thought it could trade 80 over the summer. And I still think this is one that's going to surprise people. And they look, not that it's that big a deal because I guess $20 billion on a $150 billion market cap is significant, but they announced a stock buyback too. So I think Citi is the one just on valuation that I think you can get your head around.
All right. I'm going to say it one more time. Before we get out of here, can Jacob pull up the KRE? This is the KBW Regional Banking Index. Now, this is interesting to me. This might be the most interesting thing to watch today, guys. So obviously there was, all right, let's just look at that November 6th gap, right? And the stock or the ETF kept on going. And the hope was after the election, deregulation, right? And look what happened there. It gave the entire thing back and then some. It got to its 150-day. Look at that 2-day move, right? Since that reversal a little bit, since it bounced, I guess, 3-day move. Let's go to a 2-day chart here for a second. So it gapped up. The high of the day was the open. Here we are. We're trying to find a little level here. Guy, if this thing were to take a leg lower and head back towards 61, am I putting too much emphasis on what this might mean for the financial?
No, I think you're right. And it's sort of, it goes back to conversation we had probably about 18 or so minutes ago talking about the banks and, the history. And when I say history, the last couple of years, you've had these moves to the upside in a lot of these names post earnings, only to give a large portion of it back in the days and weeks to follow. So to your point, the fact that it's happening, 5 hours later, I think is something to continue to watch.
All right.
Is that it now? Are we now ready to go?
Let's get out of here. And you know what?
By the way, I'm so freaking right about if you're right now, let's say you're a high school kid, or maybe you're a football player in college, okay? And if you're getting your asses handed to you, don't be one of those assholes that's flexing, or if you catch a pass for first down, starts doing the friggin' first down. Don't do it. You're a Johnson if you do it. And by the way, if I was your effing coach, your ass would be sitting next to me for the remainder of the game, if not for the remainder of the game and all games moving forward. I don't need that shit on my team. Back to you.
Okay, I love that.
Well, tell me I'm wrong. Tell me I'm wrong. What's wrong about that?
Here's something
it's such an ESPN society. It's all about me. Watch me. I don't give a shit what the team did. Watch me. Watch me.
So here, I have a question for the audience.
I thought we were leaving.
We have a very active chat on the YouTube during these programs. Okay. So on Monday on 5 o'clock on Fast Money, Melissa Lee announced that we were going to do a live. We talked about it yesterday. A live Fast Money at the NASDAQ. You buy the ticket, you come to the show, you take pictures on the set, we do a Q&A afterwards, and we even have cocktails with the folks there. And those tickets sold out in a day and a half like that. So my question to you people is, Guy and I often go to many of our sponsors events where they have users and, other folks there, that sort of thing, customers and stuff. Should we be doing a live market call somewhere? Whoa, wouldn't that be kind of cool? Very interactive, that sort of thing.
Yeah, we could do that. I don't think we're gonna charge people, but we might show up in your hometown. That'd be fun.
Yeah, or we just do a live event in New York and we bring some of our major contributors to the program. We get a bunch
NYC
of sponsors there. Yeah, it could be cool. So you guys write in, contact@riskreversal.com.
By the way, almost up to 100,000 on a YouTube thing.
Yeah, on the YouTube thing.
Long hair at the Madison Square. That's a line, by the way. Do you know the line? You know what that's from? Long hair at the Madison Square.
As soon as you say it, I will know.
It's a lyric in a Paul McCartney and Wings song.
Oh yeah,
Venus and Mars into rock show into Jets. Long hair at the Madison Square.
All right, guys, gals.
Madison Square Garden
here tomorrow. Guy is going to be.
I'm coming in. I'll be sitting next to EYT.
Liz Young Thomas from SoFi is going to be here with Guy for Market Call. Then Guy and Danny are going to do it on the tape. That drops on Friday. So we've had a big week here. It's been fun.
I have fun. Bill Hockman just sent me some picture that looks like a match. Like
he's basically saying you're fired today.
Is that what that means?
Straight fire.
Can't people just say that? Do you have to talk in fucking pictures?
Oh, geez. We almost got out of here.
Sorry. Jacob, edit that out. I apologize.
We almost got out of here without an F-bomb. We had a lot of effing. But no,
because, there's certain things that I do get exercised about, and that's one of them. It just drives me nuts. It's the me generation. It's all about me. It's all, listen, we're getting our doors blown off, but hey, I had caught 8 passes for 115 yards. I did my job. No, you didn't. You lost.
Okay. Thanks, everybody.
I don't know what else to say.
Guy will be back tomorrow.
I don't know what else to say.
Thomas.
I don't know what else to say.
I'll see. And Monday we're off. It is
MLK.
MLK Day, so enjoy that, people, because I will not be here. But on Tuesday, you and I are going to be back.
Am I allowed to say where you're going, or is that dexing you?
Doc, I'm going to London. I'm going to
Oh,
London.
you just said it.
Well, you're not doxing
By the way,
me.
Dex was a character on General Hospital. He was Joss's love interest. Joss being the stepdaughter of Sonny Corinthos. Dex was recently killed off, which really upset me.
Wait. How do you know? Hey, I got to do this. So when I was young, I was a latchkey kid. Okay, you probably were too.
I know what that means. It means you have a key to get in your house because your parents are both working.
Yes. Okay. But we had a woman named Mrs. Davis come to the house. Okay, because my parents didn't get home until after 6. And sometimes she'd make us dinner. Sometimes she'd, just kind of keep an eye on us. But when we got home from school, she'd be sitting there every other day. She didn't come every day. She'd be sitting on the sofa. She'd be smoking a butt.
No.
Yes, in our home. This was 1982 or 3. And she'd be watching General Hospital. And there was this couple that was called who? It was
Luke and Laura.
Bang. And she would sit in there and she's hacking butts. She's watching Luke and Laura. And then we'd say, Mrs. Davis, what's for dinner? And you know what she'd say? She'd take her cigarette out of her mouth and she'd say, shit.
Because she didn't cook anything yet. Because she's engrossed in GH.
Just say shit. Now, the other thing in the Nathan household, anytime something went missing, anytime.
Mrs. Davis's fault.
Mrs. Davis did it. This is Nathan household lore. Okay. These stories go back so far.
Mrs. Davis did it. No, of course. I mean, that's an easy, that's an easy out.
And then she was kind of, she lost me. My brother and I have a twin brother. And we used to have these bamboo. We had this bamboo forest. This is in New Jersey, like in our backyard. And I think what the builders did, they built all these houses and they put bamboo because it's really cheap and it grows.
By the way, bamboo is a weed. It's intrusive. Once you grow bamboo, like the root system, and you can't get rid of that shit.
Well, I'll tell you one thing. It was really fun. We would climb up normal trees and we'd take a bamboo. This is the dumbest thing. Do not do this, kids. And we jump on a bamboo thing and we try to ride it down. Like you know what I mean? That was really dumb. But one time my brother and I,
pole vaulter,
one of our friends, we saw this movie where they had torches. And so we went in the bamboo forest and we made torches. We just thought that probably like Raiders of the Lost Ark or something like that. And we took, like a bed sheet or something like that. We put it on a piece of like stick or something and we made torches, and Mrs. Davis narked on us.
Yeah.
So,
well, because she caught on, like you kids, you're not going to rat me out. I'm going to rat you out before.
I think she was more worried about covering her own ass.
CYA, Mrs. D.
All right.
I wonder if Mrs. Davis is still, that's 1980s. That's 40 something years ago.
She'd be like 100 years old.
Met her demise.
Yeah. But
this is fun. See, Amanda's not here to yell at me. Pandas eat 50 pounds of bamboo a day. No shit. That's from Bill Hockman. Bill Hockman.
Wait, who eats it?
Pandas.
Huh.
And that's why the panda produces more than 22 pounds of shit per day. That's like me. I produce that just on our show.
All right, we're out.
Save that, man. Cut that shit up for a
We're out.
All right.